All right, everybody, let's finish up the chapter now and start off this particular video talking about ratio analysis. Ratio analysis refers to the financial ratios and margins that management uses to compare their firm's financial history to that of other companies or to industry averages. These ratios will measure things like liquidity, debt, and capitalization, all of which can be calculated with data drawn from financial statements. One thing that we do want to keep in mind here when we're talking about liquidity, we're referring to a firm's ability to convert assets into cash. So how quickly can things be sold off in order to get a quick influx of capital into the corporation? But ratio analyses will use that along with debt and capitalization to help to see the basic financial health of a company in addition to some of the financial statements that we have talked about. Various ratios you can find in your textbook and how they're represented. Liquidity ratios would be the current ratio, which basically takes a look at the current assets and you divide that by the current liabilities. The larger that number is, the better. The acid test ratio, you divide liquid assets by current liabilities. And again, the larger that number, the better it is for a company. Debt ratios include the leverage ratio, which is dividing the total debt by the total assets, and the debt to equity ratio is dividing total debt by total equity. Of course, these numbers we want to be small. The smaller that number is, the better the health of the company is. Capitalization ratios include the ratio of preferred stock to common stock and the ratio of long-term liabilities to common stock. These, again, are going to show the overall financial health of a company based on what it's making in terms of what it provides for its stockholders and also in terms of the liabilities that it has in terms of its obligations. Growth measures, they calculate the growth of revenue and assets over time and show historical trends. These measures include growth of revenue, operating income, assets, and net worth. And if you want to take a look at how these things are manifested, you can look at the table in your textbook. It'll give you a better idea of the way that some of these things are being used. Performance or profitability measures measure the financial strength of a company or an industry. Key measures include the return on sales, return on assets, return on equity, the price-earnings ratio, and profit margins. There's, again, a table in your textbook that shows what each of these figures are and what their importance is. Now, the break-even analysis. So the big question that we have in any business, because we're interested in making money, is how many units of a good must a company sell to cover all expenses and earn a profit? This is what we call the break-even number. And there's two types of costs that we need to consider here. There's fixed costs and there's variable costs. Fixed costs represent fixed inputs such as buildings, land, and equipment. The value of those, for the most part, does not change, at least generally do not change wildly. Variable costs, such as the cost of labor, programming materials, supplies, these things will change over time as you hire new people or give raises to people that have been there for a certain period of time. That's going to change the number of people you have in the company and how much you're paying. That changes the cost of labor. Programming material, that can change from program to program to program. And of course, the cost of supplies fluctuates over a short period of time. So fixed and variable costs are two things that you want to consider, which means that the amount that you're spending on things that you need for the company is going to change and at times may change significantly. So you can imagine that break-even analysis would change over time as well. But if you're trying to look big picture, you're trying to determine and forecast what those costs are going to be, and therefore what you need to be able to do in terms of sales and in terms of revenue in order to get to the point where your revenue overtakes the expenses that you have. The break-even point, usually referred to as a quantity, may represent something different for different kinds of businesses. So for us in media, for example, we could look at the number of advertising units sold. If you're dealing with a local cable operator, it could be the number of subscriptions that you have, as well as advertising revenue there. So basically what we're looking at is trying to put some sort of a quantitative value on how much business do we have to do in order to hit that point where we're no longer in the red, where we owe more than we make, and be in the black, we're making more than we owe. Now, we talked earlier about depreciation and amortization, in particular on amortization. The thing here is that when we're talking about these two terms, depreciation is a tactic that we use to figure out the value of some of the assets that we have over a certain period of time. And those are going to be more the fixed assets. The intangible assets are those things that we deal with amortization. And some of the methods that we use in amortization, there's a couple of different ways that we determine what that value is going to be over several budget periods. One is called the straight line method. Straight line method offers a fixed deduction every year. So say you're going to be taking this value over the course of 5 years, for example, you're going to take away the same amount of money in terms of value in year 1 as you do year 2 and year 3 and on and on. Declining value deducts the costs at a faster pace so that perhaps there's a huge amount of money that is being taken into account as part of the declining value in year 1, then not so much in year 2, then not so much in year 3. The table in your textbook has a good example of what we're talking about here. So you see that a company bought an asset and it is got a value of $200,000, and they're going to take that value of $200,000 and depreciate it over a period of 5 years. In the straight line method, they're taking the same amount out year after year after year, versus the declining value method. They take a larger amount out for year 1 and then prorate that value as the lifespan of that product goes along, to where they actually don't recognize any value in the final year. That may or may not be the case every time that you do a declining value amortization, but it's basically that idea that you consider the loss of the value of something more significant when you first own it, as opposed to treating that depreciation equally year after year after year. Now, reporting financial performance. Executive summaries are concise reports that one can read quickly to gain an overview of a firm's financial progress. Rather than containing detailed financial statements, it consists of a narrative that explains the financial condition of a firm. So instead of necessarily looking at a bunch of charts and graphs and ledgers with numbers and that sort of thing, it gives in a descriptive paragraph sort of form a sense of what's happening with the company, where the successes are, where the things are that have not done so well, and those sorts of assessments on what happened in the previous reporting period. Quarterly reports provided for both owners and stockholders highlight progress from the previous quarter and explain any changes in the financial stability of the firm. Such reports contain financial statements, and the most common of those financial statements would be the profit and loss statement or the income statement for the past quarter. So it helps to see how the company is doing from a revenue standpoint over the past 3 months. Annual reports are provided for owners, stockholders, and the SEC, which is the Securities and Exchange Commission, and that is very important, especially for the public corporations, so that they are staying in compliance with the law in truth and disclosure. These offer the most detailed information about a company and are prepared with care and precision as a result, so that there is that truth of disclosure, and legal ramifications from the SEC are not something that they would need to worry about. In order to make sure of that, you're going to, as a company, hire a certified public accountant or a CPA to act as an auditor to verify the accuracy of that financial data provided by a firm. An auditor's statement of verification is found in every annual report and sometimes in quarterly reports as well. So that's going to wrap it up for the financial chapter. Make sure you finish up the study questions and the notes, get those turned in. Take a look at the questionnaire for the chapter to help fuel the discussion when we get together. And this might have been a daunting chapter for some of you that don't necessarily have a strong suit in numbers or finances or things like that. What I would say to you is that a basic understanding of trying to figure out and troubleshoot where your money is going, how much money you're bringing in, can help to determine what your strategy should be down the road in terms of your operating costs, in terms of the products and services you provide, what you charge for those, how you generate sales and that sort of thing. And basically, to have a basic understanding that these tools are available from a financial standpoint to help managers make those decisions is going to be especially important. And if for no other reason, many times the manager is in charge of putting together and or enforcing the budget on the particular department he or she is responsible for. So it's a good idea to get at least a bit of a sense of how the numbers impact you and how to respond to them when they come your way.